Thank you for joining me today. We're going to discuss saving for college with Michigan's 529 College Savings Plans, the Michigan Education Trust, and the Michigan Education Savings Program. As you probably are aware, having some sort of higher education degree, whether that's a bachelor's degree, graduate degree, etc., does pay off in higher earnings over your lifetime, but it also pays off in regards to unemployment rates. So people who have higher degree levels, such as a bachelor's degree, tend to have lower unemployment versus somebody with just a high school diploma. They're also expected to earn about $1 million more over their working lifetime than someone with just the high school diploma. If you haven't been in college for some time, you may not be aware of how much college actually costs now. If you're going to attend the University of Michigan, Ann Arbor, an incoming freshman is going to pay about $15,500 in tuition, along with another $12,000 in room and board. So you're looking at about $27,500 just for 1 year of tuition. Michigan State's not that far behind it. You're going to be about $25,000. Central Michigan is about average cost of the Michigan Public University, so you're looking at about $22,000. One way to really save on education would be to start at a community college, and those tend to be much cheaper. Grand Rapids Community College tuition right now is about $3,400. Those room and board expenses typically aren't incurred because a lot of times students live at home still, so that is a great way to reduce costs. Kalamazoo College is a private Michigan university, and that tuition is looking at about $50,000 per year plus room and board. And then also, just to show you what an out-of-state tuition rate might be, Indiana University in Bloomington with tuition, room and board is about $47,000 per year. You want to take a look at that and also multiply that by 4, because that's what you'd be looking at for a bachelor's degree. It is said that children of low and moderate income families who save for college, they're more likely to attend college and also 4 times more likely to graduate than non-savers. So that's where we really want to look at saving for college, not only the impact on reducing student debt, but the impact of the child actually attending and completing their university studies. How are Michigan families paying for college? It really is about 30% scholarships and grants, which are great. Those are free money that you do not have to pay back. Not everyone is going to qualify for scholarships and grants, but on average, about 1/3 of the costs are covered that way. You're also going to look at about 1/3 of it being from parent income and savings. That is going to be things like these 529 savings plans. Many times people are also saving in just regular savings or checking accounts, and those might not be the best ways to save, and we'll kind of discuss that in a moment, but people are saving that way. It is true about people who save in 529 plans do on average have a higher savings rate than those just saving in a traditional bank account. That is one thing to consider when coming up with your college savings game plan. And then finally, 1/3 of your cost of college is going to be covered by borrowing, whether that be student borrowing or parent borrowing. It is about 1/3 of the college costs the way people are paying for it. And when we're talking borrowing, the average Michigan graduate has about $32,000 in student loan debt, and that is quite a bit over the course of time, and is higher than the national average. And 59% of those graduating from a Michigan college do have student loan debt. So we're really trying to reduce those numbers by informing you of ways that you can save, such as the 529 College Savings Plan. Michigan actually has 3 different 529 college savings plans, and when we're talking 529, that's strictly an IRS code, so that's where they get their names. MET is a prepaid 529 plan. Essentially, you're buying your college credits now based upon today's prices, and then MET will pay out at future tuition costs. It is the oldest college savings plan of this type in the nation. We've been around since 1988. So that is something to consider even prior to the start of 529 plans. MESP is a direct sold investment savings plan. So think of it kind of like your retirement plan for college. You're going to put money in, choose different investments, and however that money grows, you can use that on education in the future. MESP has been around since the year 2000. Finally, we have the MI529 Advisor Plan. This is similar to MESP in the fact that you're putting money in and choosing investments, but with this particular plan, you're working with a financial advisor. So it is going to cost you a little bit more because you do have to pay for that advisor, but you may get some additional investment options. We're not going to really talk about that one today because you do have to purchase it through the advisor. We're going to talk more about the direct sold, the MET, and the MESP. Both the MET and MESP do have a lot of things in common. Both can be used for any eligible institution that can be in-state, out-of-state, public schools, private schools, trade schools, even some international schools. Basically, any institution that can accept federal financial aid, we can somehow pay them with a 529 plan. Unused benefits can be refunded or transferred. So if the original beneficiary doesn't go to college or they don't need everything that you've saved, you can either take a refund on that, and that would be considered a non-qualified withdrawal, which means that you might pay taxes on the earnings portion. Or you can transfer those unused benefits to a family member of the original beneficiary. And that family member could include their own child someday, niece, nephew, cousin, sibling, spouse, lots of options. The biggest benefit to a 529 plan is the tax benefit. Since both are 529 plans, they both qualify you for some tax benefits, including a Michigan income tax deduction. With MET, you can deduct your entire purchase price or contribution amount made in any given calendar year off your state of Michigan income tax. With MESP, you can deduct up to $5,000 per year for single filers or $10,000 for joint filers. If you do both programs, you can take both deductions. Both of them, if they're used for qualified education expenses in the future at a qualified institution, they're going to grow tax-free. So any earnings you won't have to pay taxes on in the future. They are treated as gifts to the child. So if you're looking at doing some estate planning, that's a great way to do it. So you'd want to consult a tax advisor as in regards to your specific tax advantages. When you decide to purchase a MET or an MESP, you have lots of ways to make contributions. You can do a payroll deduction. This will be after-tax dollars that are contributed right from your paycheck into the programs. It's nice because it's set it and forget it. You don't see that money, it's just automatically saving for you. You can do a bank account deduction. You can make a gift by check, or you can have friends and family make contributions too. It's really easy to make this a family affair, so maybe you get less toys as presents and a little bit more contributions into the college savings. If you're thinking about purchasing or contributing to a 529 plan, know that they have very little impact on financial aid. A lot of people are concerned that if they save, it's really going to reduce on the aid that the student might qualify for in the future. In most cases, this is going to be considered a parental asset, so only about 5.64% of the whole value is going to be taken into account when determining any kind of need-based aid in the future. Whereas if you were to stick this in a savings account for the child, it's a student asset and they can take 20% of the value into account when determining aid. So it's really going to have a very small impact on financial aid eligibility. This kind of demonstrates on what kind of impact different ways of saving might have on that financial aid eligibility. So you can see the MET and the MESP is very small. Many times people like to contribute money into their IRA and instead of using it for retirement, pull that out for education. You can do that. Keep in mind the first year you do that, there's going to be no impact on financial aid, but the next year it's going to be considered income on your part, so they can take 50% of that withdrawal into account when determining your aid for the following year. So it's going to have a much larger impact. Now we're going to discuss the Michigan Education Trust. The MET program is a little bit different way of thinking, so it might take a little bit longer than it will to do the MESP. As I mentioned before, MET is a prepaid tuition plan. So essentially, it's allowing parents, grandparents, or really anyone to prepay their college tuition costs. Essentially, you're buying your college credits now based upon today's prices, and then MET will pay out at future tuition prices. It is designed to work at a Michigan public university, but there are ways to get MET to pay a private school, trade school, out-of-state school. Just works a little bit different than it would at a Michigan public school. You want to think of MET like insurance. You don't have to worry about what the price of college does in the future or what the stock market does. What MET does is we're going to pool everybody's funds together. We do invest those in order to pay out on our future tuition obligations, but you don't have to worry about what that market does at that point in time. And it is secured by the assets of the trust. So even though MET is a state of Michigan program, MET funds do not go into a general state of Michigan fund. So those dollars cannot be used for something else that the legislature decides to use them on, strictly for MET purposes. When purchasing a contract, you're going to have one purchaser. That's typically the parent or the grandparent. You do not have to be a relative to purchase this, though. Just keep that in mind. You're going to have one beneficiary per contract. That's going to be your future student. There are no age restrictions, so you can have a newborn, you can have a current college student. Does not matter. Now, the younger the child is when you purchase the MET contract, the more you're going to get out of MET because it's a longer period of time for college tuition to increase. But we do have current college students purchase MET because in some cases it's a better deal than paying the school directly. That beneficiary does have to be a Michigan resident at the time of purchase. However, you can move out of state the next day. That's fine. It's just that initial purchase, the beneficiary does need to live in Michigan. You are allowed to name a contingent contract purchaser. We call this person the appointee. The appointee is just someone who can get contract information. They can't really do anything, but if they were to call MET and ask questions about the contract, we could actually give them specific information. You do have the option of electing that the appointee take over the powers of the purchaser if something were to happen to the purchaser. So that's just a nice option for you. It's not required. Now, like I mentioned before, 529 plans are transferable. So if the original beneficiary doesn't need their MET credits or they decide not to attend college, they can transfer those unused credits to another beneficiary or a relative of themselves. That person does not have to be a Michigan resident. So if your student grows up, doesn't use all their MET, moves to a different state, has a child of their own, then they can transfer those unused credits to that child, even though that child is not a Michigan resident. You do have 3 different contract options to choose from: full benefits, limited benefits, and community college. Community college contract is designed to pay in-district tuition and mandatory fees at any Michigan public community college. It's going to be the least expensive option for you. If you buy a community college contract and the student decides not to attend a community college, they want to attend a university instead, that's fine. We convert your credits that you've purchased into a dollar amount based upon whatever the Michigan community colleges are charging at that time, and then we direct those funds to the university that the student is attending. It's not going to pay for all the same number of credits at that university as it would have at the community college, but you can definitely use it there. Full and limited benefits contracts are designed for universities. A full benefits contract will pay in-state tuition and mandatory fees at any Michigan public university, whether it's the most expensive or the least expensive. However many credits you've purchased, we will pay whatever those schools are charging, even if it's double what you paid us. If the child has a full benefits contract and they decide to attend an out-of-state school, we convert your credits into dollars based upon the average of the Michigan public universities at that time and direct those dollars to the out-of-state school. Again, it may not cover everything at the out-of-state school. It'll depend on what they're charging on tuition, but you can definitely use it there. Limited benefits is also university plan, but it has a little bit of a formula we work in there. It's a less expensive option for you to purchase than full benefits. However, if a student has a limited benefits contract and they attend an above average Michigan public university cost-wise, we're going to prorate the number of credits that we'll pay to that school. So you can see there's a formula there on how we come up with that number, but basically, historically, the three schools that fall into that above average cost are the University of Michigan Ann Arbor, Michigan State University, and Michigan Tech. If they had a year of tuition, which is 30 credits, and they decide to attend University of Michigan Ann Arbor this year, instead of us paying 30 credits to U of M, we're only going to pay 27 credits. So it's about a class a year that we're not paying for. But if they attend Grand Valley or Central or Oakland, all those other Michigan public universities on unlimited benefits, it's going to be covered credit for credit. So you can still use it at those more expensive schools. It just may not cover everything. But if they're getting into those schools, they probably have AP credits or dual enrollment credits or scholarships or something to kind of make up the difference between what we will and won't cover. The other difference between full and limited is if they attend out of state on a limited benefits contract, we convert to dollars based upon the lowest cost Michigan university at that time and direct the funds to the out of state school. A little hint for you, if you do 2 years of community college and 2 years of limited benefits, that can get you a bachelor's degree, comes in at half the cost of 4 years of a full benefits contract. So there are ways to kind of work this into your budget and to your goals, and you can mix and match contract options as well. Once you decide which type of contract or contracts you want, you can choose a payment plan or a payment option. Lump sum is where you tell us how many semesters you want to purchase, and then we'll tell you how much that is, and then you give us that money, we purchase the contract, that contract will be ready to use whenever the student goes to school, and it'll be closed to future contributions. This is a great way if you're just going to buy the 2 years of community college outright or the 4 years of full or limited benefits outright, because then you're just kind of done. Once you get it done, you don't have to worry about it. Pay-as-you-go is our most flexible payment option. It allows you to purchase at least 1 credit hour to start, but after that you can put payments in whenever you'd like and any amount as long as it's $25 or more. Each time you put money in, you'll be purchasing credits or fraction of credits based upon the prices in effect at that time. And you just kind of build your little piggy bank of credits, and whenever you're ready to use them, you just let us know and then we'll use them that way. Pay-as-you-go is a great way to get friends and family involved as well in making those gifting contributions, because they really just need to put $25 or more in, and maybe they do that at birthdays or holidays. Pay-as-you-go on a per credit price is exactly the same as a lump sum on a per credit price. If you're looking at purchasing 1 year of tuition now and maybe next year buying another year, we recommend putting it into a pay-as-you-go account, because then next year you don't have to open a brand new contract in order to make that additional contribution. You can just add it into your existing account. Pay-as-you-go does not require you to set up monthly payments. You can if you'd like, but it is not a requirement. You can make payments whenever you'd like. Monthly payment plan is another option for you. Prior to pay-as-you-go, you either had the lump sum or the monthly payment. So if you didn't have the large chunk of money, people went with monthly payment. We're finding more people now doing pay-as-you-go versus the monthly payment just because pay-as-you-go has the flexibility. Monthly payment, you decide how many semesters you ultimately want to purchase, how long you want to pay on that, and then we will tell you what your monthly payment is going to be. Your payment options are 4, 7, 10, or 15 years. Your only stipulation is that you need to be done with your payment plan by the time the child graduates high school, so you can't put a 9th grader on a 10-year payment plan. Your monthly payment is going to be locked in for the duration of your payment plan, so it's never going to change on you. The downside to monthly payment is you do need to make those payments every month. You can't take a month or 2 off, but also we build in a 5.5 rate of return on there. So think of it like a 5.5% interest rate. So over the course of your payment plan, you are going to pay more than if you were to do a lump sum. Monthly payment has that rate of return built into there. Pay-as-you-go does not. Pay-as-you-go is subject to our annual price changes. but we would have to raise prices more than 5.5% every year for you to come out more expensive on pay-as-you-go, and we just haven't done that in a really long time. They've been 1 or 2%, maybe 3% increases per year. So just keep that in mind when you're choosing. Again, you can mix and match payment options. If you have multiple contracts, you can have different payment options for those as well. You can choose how to use your MET contract. It has a lot more flexibility than what people may realize. It is best used at a Michigan public university or college for tuition and mandatory fees, but you can use it at out-of-state or private schools. We just do that credit to dollar conversion. You can transfer among schools. You just need to let us know where you're attending so we can inform the new school that you have available benefits. You can use this alongside scholarships. If you get a full ride scholarship, full tuition scholarship, congratulations. You can terminate the contract for a refund based upon the scholarship. We issue a refund to whoever's listed on the contract as the refund designee. You would need to pay taxes on the earnings portion of that refund, but that is an option for you. You could also transfer those unused credits to a family member. Most likely what's going to happen though is the student's going to get a partial tuition scholarship. In that case, most of the schools will still bill us for that full tuition cost. When we pay the school, we'll essentially have overpaid your tuition because of that scholarship. So then the school can use the MET money for other things on the student's account, like room and board or books, or refund it to the student as an overpayment. If you have extra credits available, you can use it towards a graduate degree. It'll pay the upper level undergraduate tuition rate. So it won't pay quite all of grad school, but it can be contributed towards that. It just needs to be used within 15 years of your expected high school graduation date. That can mean that you're using it for school, you're terminating it for a refund, or transferring it to someone else within that 15-year time period. Let's say 14 years after you graduate high school, you have remaining benefits and you have a child of your own. You can transfer those unused benefits to your child, and then your child has 15 years from their expected high school graduation date to use these. So essentially it can keep going and going. When you're ready to use MET, you just need to let us know where you're attending and tell us that you're ready to use it. We do not know that you're going to college and want to use your MET until you tell us. So depending on what school you're going to, there's a different form to fill out, and you can do that online or by paper. If you only buy a year of MET, you are not required to use this your freshman year of college. You can wait and use it senior year of college. Senior year is your most expensive year. Most schools charge more for seniors than they do freshmen, plus tuition increases each year. Therefore, you can tell us when you're ready to use it. So if you don't want to use it freshman year, you just don't tell us. And then when you're ready to use it senior year, you just submit the form. This is how we calculate those dollars, whether it be to an out-of-state school or a Michigan private school, or if the student's not attending college. The most important thing on this slide is going to be the little box on the left. The total amount of the refund shall not be less than the prepaid tuition amount. If for some reason we do the calculation and that number comes out to be less than what you paid us, we give you back the difference. If college becomes cheaper in the future and we pay out less than what you paid us, we give you back the difference. So MET really is kind of like an insurance program in that way. You never get less than what you put in. When you're ready to enroll, you can do it right on our website. Our website is setwithmet.com. Enrollment this year will be open till September 30th. You can enroll by mail as well. Keep in mind that if you enroll online, typically the enrollment fee is $25. If you enroll via mail, it's going to be a $60 enrollment fee. Many times we do have coupon codes to waive that enrollment fee, so make sure you check our social media channels and website. A lot of times they're posted right there. You're also welcome to call us anytime. We are here Monday through Friday, 8 to 5. We are happy to help you with your what-if questions or your specific scenarios and determining whether or not you think MET is a good fit for your savings goals. Now we're going to talk about the MESP. MESP, like I mentioned before, is a direct sold 529 college savings plan, so you don't need to buy through a financial advisor or bank. When you open an MESP account, you're going to have one account owner, typically the parent or the grandparent. There's no state residency requirement for either the account owner or the beneficiary. Keep that in mind. And the account owner can be anybody. There's no income restrictions, no age restrictions. You just need some sort of tax identification number or social security number. Your beneficiary can be the future student. It can be a small child who is just born. It could be yourself. You can name yourself as the beneficiary. If you maybe are expecting a child shortly, you can open one of these in your name, and when the new child is born, you can transfer it over to them too. So that's something to keep in mind. And again, that state residency requirement is not in place for an MESP like it is for the MET. Contributing is very easy. You can contribute as little as $25 per investment option. So if you want to set up automatic monthly payments, you can. Again, those can be as little as $25 per investment. You can contribute really as much as you want. There's very little limits on there. Keep in mind the gifting limit, which is basically $75,000 per individual or $150,000 per couple. And there's lots of different payment options as well as investment options. And the really nice thing about MESP is that it's very low cost. So we try to keep the cost low in order to keep your savings growing that much more. The annual cost for MESP is 0.12 to 0.24, which is basically $1.20 to $2.40 per $1,000 you have invested annually. So it's very, very small. It's one of the lowest cost programs in the nation. We talked about having different investment options. There are 9 different investment options. The most popular are the age-based portfolios, and you can do those in aggressive, moderate, or conservative ways. Those are going to gradually change and become a little bit more conservative as the child gets closer to high school graduation. So it's just a way to kind of help you if something was to happen to the market when they're close to college, it's not going to impact your investments too much. But you also have some equity options, U.S., global, or international equity indexes, balanced or a fixed income option as well. There is a principal plus interest option. Basically, this is like a money market account. It's guaranteed to pay you anywhere from 1% to 3% each year. That resets every January 1st. There is no cost to do this. So it's a great way for you just to park some money, have no investment risk, no cost to it, and still gain a little bit. Maybe your child's getting ready to go to college next year and you want to be able to take advantage of the tax deduction but not have any risk associated with your money. You can put it in a principal plus interest account. And you can mix and match these different allocations as well. So if you want to do a little mixture of aggressive and moderate, you can do that. It's really up to you. You can change your investment options twice per calendar year. So if you have everything in a global equity index and you decide that's not really working for you and you want to change it over to a balanced option, that's perfectly fine. You can do that twice a year. Each time you put money in, you can also choose a different investment option. So it really is whatever's going to work best for you. There is a lot of flexibility to the MESP. You can change the beneficiaries whenever you'd like. As an account owner, you're going to maintain control of this account, so you can do whatever really is going to fit best for you. The account can be used in-state, out-of-state, public, private, trade school, international schools that can accept federal financial aid. You have a lot of flexibility on where the student can actually attend. And it can be used for a wide range of expenses. So whereas MET can only be billed directly for tuition and mandatory fees, MESP, you can also use it for books or room and board, computers, basically anything that's required for attendance. And don't forget to take your Michigan income tax deduction because that does save you some money there as well. So MESP, one of the things you might want to do is go onto the website and use the savings calculator. It's a really great way for you to kind of play around and see what your monthly contribution should be in order to meet your goals. You can kind of put some different assumptions in if you want to pay for room and board and tuition, or if you just want to do tuition at an in-state school, you can kind of see what's going to work best for you. You can also go onto our website and do a little research and see what the historical performance was for the investment option that you're choosing from. You can set up automatic contributions on the website. You can log in really anytime and kind of check and see where you're at, get statements, that kind of thing. Our website is misaves.com. You do have the option on there too of setting up kind of a virtual appointment with an MESP advisor to kind of discuss what you are looking to do, or if you have specific questions, they can kind of help guide you there. Now, we talked a lot about MENT, we talked a lot about MESP, but the big overall picture is that they're very similar programs in the fact that they're going to help you save for college. It's just one's a prepaid program, one's an investment program. We do actually recommend, if you can do both types of programs, do it. You can save for your tuition with MET, your room and board with MESP. You got the insurance type piece with MET, the investment type piece with MESP. So it just makes for a really balanced portfolio. You can do rollovers too. So if you've already opened a 529 plan, maybe through your banker or a financial advisor, you can take those funds and roll them into a MET or an MESP so that you can take advantage of your state of Michigan income tax deduction, because you are only going to be eligible for a Michigan income tax deduction if you're doing one of the 3 Michigan programs. If you bought through a financial advisor or a banker, you may have bought a different state's program. So keep that in mind. If you already have an MESP and you think you might want to lock in some of the gains you've done with MESP and buy your tuition with MET, you can roll from MESP into MET. MET, we don't typically see rolling from MET into MESP unless the contract's getting ready to expire and you don't want a refund, you want to put it into a different 529 vehicle. Well, you can always call us with specific questions about that too. If you have questions, don't hesitate to call us. We can be reached at our phone numbers here, on our websites. There are a couple local MESP consultants, so you're more than welcome to call them directly as well.